Good afternoon, everybody. Welcome back to the Opportunistic Trader. We have a special guest this morning, Mark Yusko, Chief Investment Officer of Morgan Creek Capital. We're going to be speaking with Mark on a number of topics covering the global markets and current opportunities. Thank you for joining us, joining the Opportunistic Trader. Mark, how are you today?
Doing great, Mike. Thanks for having me on and look forward to the conversation.
Yeah, absolutely. So like I said, we're going to cover a number of topics, your thoughts on the global markets, current opportunities, crypto. But I guess, can you start out by telling us a little bit about Morgan Creek?
Yep. So the quick version is I came out of the university endowment world. So brought my team over from the University of North Carolina at Chapel Hill back in '04. We formed Morgan Creek around this idea of bringing the endowment model of investing to other investors, high net worth families, individuals, smaller endowments and foundations that don't have staff. Been doing it now for coming up on 15 years. And we approach a global marketplace in terms of we look at all asset classes around the world, from public markets, private markets, and we have manager of manager products. We have some direct investment products, as well as some unique kind of special situations products. And lately, we've been spending a lot of time in blockchain technology as well.
Yeah, we've seen that, and we'll definitely get to that in a little bit. But I thought that we'd start out by talking about the U.S. equity markets, and being that we're in December here, what's caught your eye? What's been interesting about the global markets in 2018, and what are you thinking about as you look ahead at 2019?
Yeah, so I've had this thesis for a while that we were going to have a kind of a redo of 2000. I've even been tweeting about it under hashtag 2000 Redux. And the thesis goes that, we've had this massive run up in concentration in the US equity market, particularly in the FANG stocks, or FANG man, if you want to include NVIDIA and Apple and Microsoft. And that led to, I thought, the second most stupid valuations in US market history, on every measure. And, today we stand at about 108, 109% overvalued to fair value, meaning we could fall, 50+% back to fair value. And the problem is you can stay overvalued a very long time. And what's the catalyst? And I think the catalyst for bringing us back to fair value is just a series of policy errors. One, by the Fed in being too aggressive on raising rates this late in the cycle. Two, just the absolute idiocy of the Tax Reform Act, as I call it, cutting corporate taxes again at the end of a cycle, just a horrible economic idea. Deficit spending, just a wealth tax on the common person, and we, huge problems there already. And then the last is this idea of trade wars. Trade wars have never been a good idea. Two words: Smoot Hawley. And so the combination of those three things, I think, tipped us over. And it's interesting that the change occurred both on a Bradley turn date back in January 26th. Market rolled over exactly on the turn date and started to fall really hard. And then we had the whole, we'll save it and maybe we'll be more dovish. The Fed saying we won't raise as much, and the president saying, we're going to give everybody big tax cuts. And so we had this kind of hope rally through the Gann turn date on September 22nd. And since September 22nd, we've just had this very significant rollover and roll down. And I think, we're going to see exactly what played out in 2000. People think 2000 was this horrible year. It really wasn't. It rolled over in March, recovered by September, rolled over again in September, finished the year down 9%, single digits. Right. And I think we'll end up down single digits this year. Then you go into 2001, you had a recession, not a big bad recession. First quarter was negative, second quarter was positive, third quarter was negative. The whole year was actually up 1% on GDP, but it's still a recession. And the market fell another 14%. And the big year was 2002, down 22% because the debt bubble popped. And I think the same thing's going to play out. I think we have a shallow recession next year. I think we're down mid double digits. And then the debt bubble starts popping in the wall of maturities in 2020. And we get a whole bunch of company failures and a big stock market drop. And I think over the 2-year period, we end up down kind of that 40 to 50%.
Question, just going back to one of the things you just mentioned, you were talking earlier about fair value and us being significantly over fair value. How do you calculate that?
Yeah, so there's lots of different ways, and that 109 number comes from an amalgam of a combination of factors. So one, you've got just the traditional PE ratio. So what's the P divided by the actual E, the only E that we know, which is the trailing 12 months. Everybody looks at forward E, but the forward E actually never happens. Everybody's very optimistic about earnings estimates, and they actually always come in lower than estimates. So it's the actual PE. Then you've got the 10-year adjusted PE, so it kind of takes the cyclicality out of the earnings cycle. Then you've got market cap to GDP. That is a great indicator for fair value. The market cap of an economy, which is represented by the public stocks listed in that economy, should approximate around 70% of GDP, because it costs money to make money. And we're sitting up at 140% today, which is just Looneyville, second only to 2000. And I always say, comparing this to 2000 is like getting pulled over late at night, for swerving on the road, and you tell the officer, well, I'm not nearly as drunk as the guy passed out in the back seat. Someone had to drive. That's just stupid. Call a Lyft. So then you've got other measures of valuation. You can do discounted stream of cash flows on future earnings using the current discount rate. But my favorite measure is if you look at the long-term regression model of the market should go up, right? We have inflation, we have real earnings growth, we have dividends. So the market should rise, about 5 to 6% real on average over the long term. So you can draw a long-term regression line and fit that growth. The problem is the price of the market is never equal to the value. Very rare. It's like a pendulum swing. It spends very little time exactly on the middle point. And so we've been overvalued for most of the last 18 years,
right,
which is why the compound return on stocks, you bought and held back in 2000, you held to today, 18 years, okay, your average return is 3.9%. There's a technical term for that. That sucks.
Well, on that, it's this year, U.S. equities are heavily outperforming. S&P's roughly flat right now. Nasdaq's up a few percent for the year. But then if you take a look across the world, DAX is down in excess of 15%. Global markets are really down between 15 and 30%. It's a really, it's an ugly year. So looking ahead to next year, what sort of opportunities do you think that the U.S. will continue to outperform, or do you think there are opportunities elsewhere?
No, I think it's going to be exactly the opposite, in the sense that I think the U.S. is going to catch down. That's my hashtag, catch down. In the sense that, look, the global market is reacting as it should to a couple things. One, China had a bear market, nothing to do with the U.S., nothing to do with the Trump administration, nothing to do with this trade war. China had a bear market in stocks because they withdrew $1 trillion with a T. Remember, that's $1 a second for 31,710 years. $1 trillion of stimulus that they had put in the market in 2016 so that Xi could get reelected. Remember, the economy was crashing first quarter of 2016 globally. Markets were down 12, 15%, and magically everything turned around in the middle of first quarter because China pumped $1 trillion and bought oil and copper and iron ore and basically saved the world. Well, they had to pull that liquidity out of the market because inflation was raging and property prices were out of control. So they pulled that $1 trillion out. That caused their recession. They don't call it a recession. They just call it slower growth. But they're kind of in the equivalent of a recession. And all of that said, their market has gotten cremated. So they're selling at single-digit PE ratios. Anytime you bought Chinese equities at single-digit PE ratios over the next 12, 24 months, you've made really nice returns. So I think there's a really great opportunity at some point to buy a lot of Chinese A shares in particular. We'll come back to that later. Second point is that the euro, the yen, and the dollar are locked in a race to the bottom. And if you go back over the last 5 or 6 years, each one of those currencies takes a turn being the strong one. And that hurts their domestic economy. And the euro got very strong last year. The dollar weakened. And that really hurt Europe coming into this year, particularly Germany. Germany is the greatest mercantilist on the planet, right? They created the euro along with France, and they invited all the crappy countries in so they'd have a shitty currency. Pardon my French. I say that. I was with a Frenchman once, and he said, "Why do you say that? We're not vulgar." I said, "I actually don't know why we say pardon my French."
I agree.
But I think what's interesting is the euro is designed to be a weak currency. Like if Germany had used the Deutschmark, it'd be 40% higher, and they wouldn't be able to sell their cars and their machine tools around the world. So they engineer a weak euro, but they had to take their turn in the hot box. The dollar weakened, the yen weakened, because the yen really needs to weaken because of their debt problems. And the euro got too strong. German economy rolled over, and now they've got, last quarter was negative GDP. This quarter looks like it's going to be negative, so they're going to be in recession. Markets have rolled over. The European banks have rolled over because they never fixed their leverage problems. So it's kind of a mess. Now, I think what's going to happen is there's been a new Shanghai Accord, and the euro is collapsing. They're going to let it out of the hot box and let Germany get back on track. So I think there could be some interesting things to do in Europe next year, cautiously. So if you look around the world, I would say, we like the emerging markets best. We like Japan next. We like Europe after that. And we like the US the least.
So it's actually interesting. One point that you're bringing up here is you actually think that the dollar will strengthen. You're talking about euro lower, dollar yen higher. You're looking for the dollar to strengthen, but you're also looking for emerging markets to outperform, which is not typical.
Oh, no, absolutely. And again, I don't think the dollar is going to strengthen super dramatically. I think it's going to kind of meander here. I think the dollar's in a secular decline. I think 10 years from now, it's going to be materially lower, particularly versus emerging market currencies. Because I think that's where all the growth is, back to the old Willie Sutton, Willie Whitey robbed banks. Well, that's where they keep the money. So if you're going to invest in equities, you want to buy growth. And I think all the growth is going to occur in those countries, that I nicknamed CARBS, not really as a play on BRIC, but I just happened to get shamed into running a half marathon with a friend, not a runner, had never run 5 miles before in my life up until a couple months ago. And, the best part of it was I could get off my keto diet and I could actually eat carbs for a change.
Nice. Yeah, I saw that. So CARBS is China, Argentina, Russia, Brazil, South Korea, right?
South Korea. Yep. And I struggle with the S because as much as I love the China story here for the long term, and I think the stocks are really, really cheap. Love Argentina because they had to devalue their currency 50% because of the hikes in the U.S. rates. So anytime a currency devalues 50, you want to be a buyer of those equities. So I really like the Argentina story, and I think Macri's a great leader. And then Russia, Russia, it's just been a perennial frustration for me. The assets are so cheap. You take a bank like Spare Bank, 58% market share, hugely undervalued, selling at 3 times earnings, yet nobody cares around the world. So I keep hoping that people will bring it back. It doesn't have to get back to U.S. valuations, but man, if we could just get back to normal emerging market valuations, that market could double easily. And then Brazil, we really like because they finally fixed their governmental problems, and they're kind of moving forward. And even though they got this kind of crazy guy at the top, there's some checks and balances. And I just think the thing about emerging markets is Arjun Devecha, GMO, has this great line that I stole that says, you make the most money when things go from truly awful to merely bad. And that's what happened in Brazil this year. So I think there's interesting things there. South Korea, I struggle with because I really do think that the FANG story is over. And my hashtag for that is FANG's bite, right? It's their nature. And I do think that tech is going to slow down. And so the South Korean economy is one of the 4 horsemen of the growth apocalypse. So the things you want to watch for to see about global growth are the Kospi, copper prices, Dr. Copper, the 10-year rate, and oil prices. And right now, all 4 of those are in collapse mode, which means global growth next year is going to disappoint. And usually when global growth disappoints, global stock prices disappoint. So this year, cash is outperforming 90% of assets around the world.
Right.
I think cash is king could be another good story again next year. And so I think you have to be selective in where you buy and buy things that are on sale. That's my big thing. I'm a value guy. Value's been out of favor, so it has not been our best environment for outperforming the fangs. But I think going forward, starting in September, for the next couple of years, I think value is going to trounce growth, and I think over the next decade, it really won't be close.
So to kind of cover a few things that you've just recently said, you think that over the coming quarters, you think US is going to underperform. You're looking for opportunities in EM, specifically in this CARBS sort of environment, or China, Argentina, Russia, Brazil, South Korea. Um, so how would I structure a portfolio, or looking at that? I mean, would it be in ETFs? Would it be
Yeah.
individual companies? Like, how can, if a retail investor was looking at this sort of stuff and liked your kind of ideas, what sort of structure and any names that you might have?
Yeah, look, I mean, I really like the ETF ASHR, A shares. I think it's really oversold. I think it's beaten down. The thing that people are not paying attention to is that every portfolio manager in the world has to start buying A shares because MSCI has included them in their index as of June. So I think there's going to be a massive tailwind to this trade, not only over the next quarter but over the next decade, as they go from 2% to 20% at the end of 10 years. So I like that. And second, in Argentina, I don't like ARGT, which is the broad ETF, because it's got some names in there that I don't really love.
Right.
But I love the company Pam, not just because that's my assistant's name and she's the best,
Hmm.
but Pampa Energia is, 2.5 years ago, someone asked me, if you could only own one stock for the next 5 years, what would it be? I was like, Pampa Energia. So this thing is wildly undervalued. It was totally manipulated with the Kirchner era, and I think they're going to get their tariff rates back to normal. And it's wildly undervalued relative to global utilities around the world. I actually like the Argentinian banks, GGAL and BMA, um, although they're not cheap, but I think the growth story there is quite attractive. In Russia, I like Sberbank. You can also own RSX, the ETF that's pretty broad based. I also like Yandex, YNDX. I think that's an interesting company. It's got kind of the Uber of Russia involved in there as well. So I think that's an interesting company. But Sberbank's my favorite business to own long term. Kind of set it and forget it, and 10 years from now it'll be worth a lot more.
Yeah.
You go to Brazil, you could go to EWZ. There's some other plays in Brazil specifically, but I just like owning that market. I said Korea's tougher. Yeah, I like Samsung as a business, so I'd probably just buy that. Um, 'Cause I think they're the leaders in global innovation right now. They've filed the most patents by a wide margin, so that's pretty interesting. In Europe, I think you could start to grave dance around the European financials, EUFN. I probably wouldn't try to catch the falling knife. I'd probably let it hit the ground, bounce around a little while, stop moving, and then grab it by the handle in first quarter sometime.
Hmm.
Um, Probably some other
Interesting.
interesting things going on in Europe next year, but I think you just no rush to get invested there. In the U.S., I just don't. I think one, you want to be way underweight. Two, I think there are actually some interesting places to get short because there are some companies still selling at 8, 9, 10 times revenues, not earnings. Yeah, look, I think Netflix could fall a lot. And it's trading at a silly level. I think it's at 180 times EV to EBITDA. I just think that's stupid. But it's not that it's not a good company. It is, and I love their product, but I just think the valuation's wrong. So I don't know. There's a couple ideas for
Yeah,
you.
no, that's fantastic. Tons of ideas, tons of thoughts there for how to express your views. I brought up a chart. It really emerging markets, and once again, EEM is not a great basket. It's heavily, um, heavily concentrated, but EEM has heavily underperformed the U.S. markets over the past decade. And so it's interesting to take a look at some of these in FXI as well. So it'll be interesting to keep an eye on how all of these, 2018 has been a
You
very
bring up
interesting year.
two really important constructs here. Is look, EEM is emerging markets. There are two challenges with it. One is it is pretty concentrated, and it's concentrated in some of the areas that probably aren't as attractive long term. But the real problem with EEM is it's not used for emerging markets as much anymore. It's used as a risk on, risk off
Right.
tool by hedge funds, sovereign wealth funds, et cetera. So it kind of gets polluted, and it has more volatility than it should. FXI kind of has the same problem. China, the big story in China is the consumer. And the three sectors you want to own are healthcare, consumer, and tech. And the problem with FXI is it still has a lot of the banks and the financials and a lot of the SOEs. And I'm not saying that that's necessarily bad, but it also tends to be more flow dominant. So when people hate China, it goes down more. And when people love China, it goes up more. So as a trading tool, you can use it. But as a long-term investment, I'm not as psyched about that as, you take something like KWEB, KWEB, that's gotten pounded here because it owns Baba and Tencent, and people have lost their conviction for those names. But over the next decade, the Chinese e-commerce market is going to grow way faster than any place else on the planet. And I think those stocks are going to really outperform. Again, I'm not in any hurry to buy them today, meaning I'm not going to call the bottom. But I bet if you start buying Alibaba, Tencent, and things like that, and hold them over a reasonable period of time, I think you'll vastly outperform U.S. equity markets.
Yeah, interesting. So let's move on to the polarizing topic of cryptocurrencies, which I know you guys, you and your firm are active in. I know you're bullish. You have a fund structure that has opportunities to take advantage of that, the Digital Asset Index Fund. Tell me about cryptocurrencies and why you're bullish.
Yep. So a couple things. One, really wildly bullish on blockchain technology. And the reason I'm so wildly bullish on it is I think it is the sixth epoch of technological innovation over time. Everything from the steam engine to electrification to the information age. And I think the blockchain era over the next 5 years is going to develop into the most extraordinary technological wave that we'll probably experience in our lifetime. And I think the greatest wealth will be created over the next couple decades based on blockchain. Blockchain is an operating system, just like DOS was for PCs, just like iOS and Android was for mobile devices. Blockchain is going to power all of the Internet of Things, or when we live in a connected world where literally everything we do and touch will be connected. Everything will be digitized. Everything of value, from real estate to stocks, bonds, currencies, commodities, will all be crypto. And I don't mean they'll be crypto like people think of crypto now. All crypto means is cryptographically secure, and it means digital rather than analog or paper. And so as we move to a digital world, blockchain is wildly spectacular. And we have a venture capital fund that focuses on making investments in infrastructure companies that are going to build out that environment. Just like we made money building out the infrastructure for the internet back in the late 90s. We made a ton of money building out the social, local, mobile infrastructure for the mobile internet, the mobile net in 2010. And in 2024, we're going to make a ton of money doing that or between now and 2024, we'll make a ton of money doing that in blockchain. Cryptocurrency is the first application of blockchain, and Bitcoin is the first cryptocurrency that runs on a blockchain. And to me, it is the solution long term for the fiat fiasco that we have around the world. If you look around the world, fiat money is exploding everywhere you look. Zimbabwe, it crashed. Venezuela, it crashed. Turkey, it's crashing. And I think even in places like we talked about in Europe, Japan, and the US, the fiat currencies are collapsing. It's why we have the highest income and wealth inequality in the history of the United States. The elites have the highest percentage of assets, and it's the dictator playbook, right? If you are in the elite and you're a dictator and you own all the assets, so you own the real estate and the stocks, what you want is to concentrate that asset ownership into a small number of hands, and then you want to devalue your currency. And that's what has happened in every fiat currency in history. And it will happen in every fiat currency in the future, because anytime you allow a government to control the issuance of currency, bad things happen, because governments are profligate spenders. And it's not just decades or centuries. This is millennia we're talking about. We can go back to Roman and Greek times. So I think that's going to happen. And what I think Bitcoin does, it allows us to have a defense mechanism against that centralized fiat control. Then you've got other crypto that have, like Dash or Monero or some of the other privacy coins, and you have some use cases around that. The problem is there's only a dozen cryptocurrencies. Everyone conflates the term cryptocurrency when they talk about utility tokens. So there are literally a couple thousand utility tokens. All those are early stage, pre-seed stage projects. It's like, crowdsourced venture capital, and 90% of them are going to go to zero. But the 10% that don't, that actually create new technology, some of them are going to be spectacular. The real problem with utility token, though, is it doesn't give you ownership in equity or debt or cash flow. It basically just gives you access to a network. It's like a Chuck E. Cheese token. Like, I issue Mark tokens, right, and you buy them. And I go out and I buy the land, I build the building, and then I open up my arcade and I say, all right, Mike, you can come use your tokens at Mark land. And you get some utility going and playing games, but you would have been way better off saying, hey, I want to be a 50-50 partner with you. I want to own a piece of your business because you used my money to build your business. That's a bad trade for the utility token owners. Good trade for the utility token issuers. So I think when people conflate the term cryptocurrency, which is a medium of exchange or a store of value, versus utility token, I think that's caused a lot of stress in the marketplace. And
what
so,
about, oh, I'm sorry.
No, go ahead. Go ahead.
I was just going to break in and say you started out by saying you're very bullish on blockchain
technology.
Blockchain, yeah. But like, for instance, the digital asset index fund, as I see it, it's heavily concentrated in Bitcoin, Ethereum, and then a few other coins. But
yeah,
is that necessarily? It sounds like you're almost saying, though, also in a few years you're expecting the blockchain technology to be something different than just these coins. And so
oh, absolutely. And so let me get to DAIF. So we started with venture capital to help blockchain technology be adopted across. Look, I think blockchain is going to impact every industry, right, from voting to shipping to e-commerce to financial services. I think blockchain technology will do to financial services what the internet did to media, right? I mean, all the money is now in internet-enabled businesses, not the old traditional media businesses. And so I think financial services, $1.7 trillion of waste is going to get pulled out of that, and it's going to go into the people who build businesses around blockchain. But cryptocurrency, while we were raising our fund to get people to invest in infrastructure, we had people say, hey, I really want to look at this cryptocurrency as a diversifier. And so we're not, managers of crypto per se. We're more traditional managers. So we partnered with world-class operator Bitwise, and we said we want to create the S&P 500 of crypto.
Right.
Realizing that when the S&P 500 was created, not many people thought there was a need for indexes. Right? Not many people put money in indexes, and it was really not very well thought of for decades. Today, it's everybody talks about it, and it's the most popular index. But back 60 plus years ago, it really wasn't that popular. So here we are at the very beginning of the evolution of cryptocurrency, and what we said is we're going to take the model of the S&P 500, which is there's a committee that determines who goes into the S&P 500, and you have to represent the best in U.S. business. So they kick out Woolworth and put in Yahoo, or they kick out GE and put in Twitter. Those are decisions that the committee makes based on what their view of American business is. So we do the same thing with our indexes. We decide which cryptocurrencies, remember, there's only about a dozen of them, right, that we think are representative of future use cases, either for store value or medium of exchange. Then we say the second criteria for the S&P is you have to have the majority of your shares freely float. So we said we'll also use that criteria. So any token where the majority of the coins are owned by a centralized authority, and so that excluded both Ripple and Stellar because they have these big foundations that own big chunks of their coins.
Mm-hmm.
So we create what we think can be an institutional quality index. Now, we only launched it in August. So, we didn't launch it 5 years ago or 3 years ago. We launched it in August. And look, it's been a tough couple months. There's no question. And I fully admit, said on CNBC the other day, I really thought we had bottomed in Bitcoin at 5,900. I thought that's where the weak hands were going to fold, the people who chased the price when it got stupid last December. What I missed was this rehypothecation issue around futures that allows people to sell Bitcoin that they don't have. And I didn't think you could do that with cash settled futures, but it turns out I was wrong. And so anytime you've got that kind of paper supply, you can have dislocations in price. You see that in the oil markets, you see it in the gold markets, you see it in the silver markets. Anytime where you can, like in the old days, if I wanted to sell you a barrel of oil, I actually had to have a barrel of oil.
Right.
With futures, if I want to sell you a barrel of oil, I can sell you a barrel of oil. As long as we settle the future before delivery date, it's all good.
So you actually think a fair amount of this decline is because of speculators?
Absolutely. Oh, no, 100%. So look.
But isn't the spec position that long?
Again, I think it's all about how you count it. So I believe that the net futures position is net short. Now, again, unless I could have bad data, but I think the net futures position is short. I think there's a lot of people that are net long, and there's lots of wallets that have never traded. So I think the physical ownership is very net long. But
right.
Again, I believe that the futures position is net short.
Right.
And here's the thing. In every S-curve, and I wrote about this in my last letter called Patience is a Virtue, that in every S-curve of adoption, right, you have the innovators or the believers who actually create something. It's 2.5% of the population, and they create this new technology. Then you have the converts, people like myself, who weren't there at the beginning, but came in relatively early, got excited about it. And that's about another 11, 12% of population. And those people then start to build things and start to invest. And then what happens is the price starts to move. And that's when the speculators come. And you get into this period called the frenzy. And the speculative frenzy, and it happens in every new technology or new asset. And the speculators come in and all they care about is price. And that doesn't make them evil people. It just makes them speculators, right? They like to buy things that move. So they cause a price bump and you get a bubble. And we've seen these parabolic moves and crashes in crypto really since its inception. And that's the nature of networks, right? Networks grow along Metcalfe's law, along the nonlinear parabola, but the price is not equal to the value. The value is very determinable by the number of people in the network and the formula, number of transactions, et cetera. But the price is just what two people decide to sell or buy at some small amount of the asset. And so the price got to a really high point last year. You had a speculative frenzy. And now those people are selling, and these speculative futures players can exploit that panic, and they can actually seed the clouds by pushing the price down more. And you see this in stocks all the time, right? Look at NVIDIA. NVIDIA is down 49% in the last 35 days. Did NVIDIA's value really change by half in the last 35 days? I don't think so. So, look, derivative markets allow the dance between investors with a long-term focus and speculators with a short-term focus to tango. Sometimes the investors win, sometimes the speculators win. Now, what happens in this S-curve adoption is you're going to get a discontinuity or a dislocation or a burst, whatever you want to call it. We've had that. And now what you're going to see is the builders come in. And think about the internet. In the 2000 bust, 2000, 2001, 2002 bust, you basically had all of the important companies created in the internet post that bust. So the Puma technologies, the art technologies, the digital islands, they all went away. They were, overvalued, not really, there was no there, and they got found out and those companies went away. But the new companies that emerged, things like Google and Amazon and Facebook and all these companies. Who would have thought in 1996, when Google was the 21st most popular search engine, that it would be a verb? Not many people.
Yeah, no, that's a good point. So two questions. You've been so generous with your time. It's a really interesting conversation, and I know you have to go. But two follow-up questions. So one is blockchain. If somebody's bullish blockchain but not bullish crypto coins, how can they possibly express that view? Are there other opportunities?
Well, a couple things. One, people should never say that. Never say I'm bullish blockchain and bearish Bitcoin, because Bitcoin is the fuel that will drive blockchain adoption. And there's lots of reasons why, and we can do it on another day, but that's people like to say that, I'm bullish blockchain but bearish Bitcoin. It's just a silly thing to say. So now you can be bullish on blockchain technology, and there are ways to play it, but they're not mutually exclusive. In fact, they're very integrated over the long term. Bitcoin's going to be used as a medium of exchange on a lot of the microtransactions, and it's going to be utilized in a lot of the networked programs that the blockchain enables over time. So they're very inextricably linked going forward. But that said, if you want to get involved in this market, the challenge is most of the good businesses today are still private. We're still in the early stages of this developmental wave. We're only, maybe 89% or 11%, 12% into the S curve adoption. So we've got a long way to go. Now you can play in places, like, AMD and NVIDIA. Some portion of their business supports the mining, which supports the security of the network. Mm-hmm. It's a whole nother conversation for another day. You can play in some of the companies like IBM and Microsoft that are making plays in this space. But the real challenge is the exchanges are still private. Although ICE, the owner of the New York Stock Exchange, is making some interesting moves here with Backed coming out in January. So there's probably some ways to play there. NASDAQ is making some noises around this space. So it's tougher to play directly. But one of the ways you can play it is actually on the short side. So you can go around and you can look at the industries or businesses that are going to be disrupted by this new technology. And I think you'll see lots of examples of that. Take healthcare. There are a lot of businesses today that are going to lose their monopoly on data when you and I can own our health data. One of the things that I kind of giggle at is, people use Facebook and they think it's free. Well, it's not free. You are the product, right? They're selling your data. Anyone who uses it, not you personally, but anyone who uses Facebook, they're taking your data, and Zuck's a billionaire and you're not. So the difference is, why don't we own our data? Or people buy, they send their DNA to Ancestry and they think they're getting a deal because they pay $49 and find out where their ancestors are from. And what does Ancestry do? They sell that DNA to the drug companies for thousands of dollars. How about we sell our own DNA to drug companies for thousands of dollars? Better trade. So blockchain is going to enable businesses, or it's going to enable the owners of the information to actually profit going forward. And I think there's going to be some very interesting shorts in places like healthcare, or other administratively burdened businesses, governmental support businesses, business process outsourcing. Now let's just take Uber and Lyft, the big announcement that they're both trying to go public. And look, we have investments in both, and I hope they get public, and I hope we get liquid, because at some point, if Mike, you've got a car and I need a ride, if we have a blockchain solution, a decentralized solution, as long as I can verify your trust on the blockchain, and as long as I can verify on the blockchain that you're a trustworthy driver and you can verify that I'm a trustworthy rider, we don't need to pay 30% to somebody else to hook us up. So that will happen at some point. And there'll be decentralized solutions for, Facebook and Google too. Why should I only see search that people paid for? It drives me crazy to think that, Alexa now is supposedly going to cut a deal with Morgan Stanley, and Morgan Stanley research is going to come up when you ask Alexa for investment information. That seems horrific to me. I don't want who paid for it. I want generically what other people are looking at. And I want to use the power of global data, not what somebody pays to be higher on the SEO.
Yeah.
So
what about market cap? The fact that we're close to about 100 billion total right now, is that a hindrance for the growth going forward? Like people looking to invest, but it's in a way almost too small?
look, it's a very important point. I said we're early days, and I'm talking about a multi-decade opportunity, and one where I think you're going to measure the market cap of crypto assets. That's cryptocurrencies, crypto commodities, crypto equities, and crypto debt in the trillions of dollars. And one of the great things about investing, and maybe we'll leave it with this thought, is the greatest wealth is created by being an early investor in innovation, which means you have to believe in something before the vast majority of people even understand it. And that's a very uncomfortable position. You'll be ridiculed, you'll be made fun of, you'll be said you're a stupid idiot. But at the end of the day, it's all worth it. And, investing in innovation, I always think, in fact, people talk about stocks, bonds, currencies, and commodities, the four asset classes. I actually perceive innovation as the fifth asset class. And if you look at the best investors around the world, I just gave a speech on this in Dallas yesterday, that the best investors in the world, the thing that they're always overweight more than everybody else is innovation.
Yeah, I mean, that makes sense. There's always opportunity there. And I think that's part of the investing landscape, like what you do, is you're looking for opportunity and you're looking for innovation.
Yep.
So, Mark, I really appreciate it. Great conversation. It went a lot longer than I expected. And I could keep you here for another few hours. You got a lot of great information.
Just set up another one. We'll do it again.
Yeah.
I love these kind of conversations. I love when the host is prepared and has great questions and has an idea of where you want the conversation to go. And I don't do short well, so I apologize for that. But
no,
we'll
we love it. We love it. And I'd like to hear also in the future about the $1 million challenge, who might be taking the other side of that bet. I know that it's been an interesting one out there, but I really appreciate it. So this is Mark Yusko, Chief Investment Officer, Morgan Creek Capital. A lot of great information. We really appreciate it.